Mutual funds and index funds are both popular investment options, but they work in different ways and cater to different types of investors. Mutual funds can be actively or passively managed, while index funds are always passively managed and aim to track a specific market index. Understanding their differences can help you choose the best option based on your investment goals, risk tolerance, and costs. Let's break them down. What are mutual funds? A mutual fund is a professionally managed investment fund that pools money from multiple investors to buy a diversified portfolio of stocks, bonds, or other securities. Some mutual funds are actively managed, meaning a fund manager selects investments in an attempt to outperform the market. Others are passively managed, meaning they follow a market index. Key features of mutual funds: active or passive management. Some funds are managed by professionals who try to beat the market, while others simply track an index. Diversification. Investors gain exposure to a mix of stocks, bonds, or other assets. Higher fees. Actively managed funds charge higher expense ratios due to management costs. No intraday trading. Mutual funds are priced and traded once per day after the market closes. Minimum investment requirements. Many mutual funds require a minimum investment, often ranging from $500 to $3,000 or more. What are index funds? An index fund is a type of mutual fund or exchange-traded fund (ETF) that aims to replicate the performance of a specific stock market index, such as the S&P 500, Dow Jones, or Nasdaq. Unlike actively managed mutual funds, index funds do not try to beat the market, they simply track it. Key features of index funds. Always passively managed. The fund mirrors the performance of an index rather than relying on a fund manager to pick stocks. Lower fees. Since there is no active management, expense ratios are significantly lower. Diversification. Investors gain exposure to a broad market without selecting individual stocks. No attempt to beat the market. The goal is to match the market's performance, not outperform it. Can be structured as mutual funds or ETFs. Some index funds trade like mutual funds, while others are structured as ETFs, which can be bought and sold throughout the trading day. Which one is better? Choose mutual funds if you want professional management and are willing to pay higher fees. You prefer active investing, where fund managers try to outperform the market. You are comfortable with the potential for higher gains, but also higher risks. Choose index funds if you want low fees and a passive investment strategy. You prefer consistent market returns without the risk of an underperforming manager. Conclusion. Mutual funds and index funds both offer diversified investment opportunities, but they differ in management style, costs, and performance expectations. Mutual funds are better for investors who want professional management and are comfortable with higher fees, while index funds are ideal for those who prefer a low-cost, passive investment strategy that tracks the market.